following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So we're talking about money today. Once again, here on Saturday, the answer about money. You know, like I said the last week and the week before that I was out of time, that I would have to wait for rebalancing. And talking about rebalancing, well, today is the day we're going to talk about rebalancing. That's coming up this week. You know, how do you make money in stocks? That's a question that's well worth considering. We're going to talk about that today. And dark matter, dark energy. Have you heard of dark matter and dark energy? Know what they are? I think there's a lesson for us in investing and in theory, the theory of economics. We're going to get to that. And today you're going to hear a lot more about Seattle when my guest has something to say about that. But first, the simplest rule to make money in stock market is to buy low and sell high. That seems almost crazy to say. Seems simple. It doesn't take rocket science. That works for stocks. And most financial advisors are managing mutual funds and ETFs and not stocks. And so for that, the rules kind of change. Every year, every quarter, many financial advisors will rebalance portfolios. And I said a couple weeks ago I would talk about that because rebalancing is happening if you're halfway through the year. You've just gone through a rebalancing, or if you, at the end of the year, you do a rebalance, or the beginning of the new year, a rebalancing. And in my opinion, it's one of the most difficult things to do when you're managing mutual funds and ETFs. Now, I will disclose that most of my portfolios, all my individual portfolios, are in stocks. They're not in mutual funds. The only mutual funds that we have are mutual funds that are in ETF, are in 401ks. That's the only place where we put mutual funds. And I don't rebalance. I want to say both of those, and there's a reason for that. Do only stocks in individual accounts, and I don't manage any ETFs because I feel the history is too short. I only do mutual funds that have at least a 10-year track record being managed by the same manager or the same committee with no changes. I've talked about that before in the program, about the number of manager changes and about the number of mutual funds that actually die when they don't perform well. That mutual funds that are actually merged into other mutual funds. Small funds that suddenly become large funds because the large fund has a terrible track record. The small fund has a good track record. And suddenly the small fund becomes the track record for the big fund. All that goes on. I don't do any of those. I want to know the manager is the same, the mutual fund is the same. But for my individuals, I just do discretionary accounts. So as I talk about this, I'm talking about something that I don't do. I'm talking about something that has some merits and has some demerits to go along with it. But before I get to the mutual funds and ETFs and rebalancing, first I've got to talk about stocks, because stocks are not a zero-sum game. Zero-sum games are where if one person wins, another person loses. Managing portfolios, on the other hand, is kind of a zero-sum game, because if somebody actually outperforms the market, somebody underperforms the market. And it's taken in aggregate. If you look at how everyone does, it's the market average less the fees. Get you somewhere close to what the total value of managed money is. Eugene Fama shared the Nobel Prize in 2013, showing that fewer than 7% of professional money managers actually do as well as the market when you add in their fees. Some do a little better, some do considerably better than the market does when you consider fees. But only 7% actually earn their fees. But if you look at the stock market in the long term, it's been increasing over history. You know, one of my favorite things to say is that on January 1st, 1900, the Dow was at 66. And on December 31st, 100 years later, the Dow was at 11,467. During the 20th century, the Dow went from 66 to 11,467. Not a bad return. But about half the time when I buy a stock, in the next few days or a week or a month, the stock's actually lower than I purchased it. Half the time it's up and I'm really happy. Half the time it's down. And sometimes it's the market. Sometimes it's just the stocks hit a rough spot and dive down. Peter Lynch once wrote the book, One Up on Wall Street. And in that book he said, if you cannot convince yourself you're a buyer when you're down 25%, then you'll never have better than mediocre returns. And what he meant is this. If you believe that a stock is going to be much higher in the future, and it has a setback, it misses earnings, somebody comes out negatively, somebody wants to short the stock, something happens, and the stock takes a drop, it's a chance to buy it at a better price than you originally did. And when you can actually buy the stock at the lower price, wait 31 days and sell the original stock at the higher price, you get a tax benefit. I manage stocks that way. I started in the business as a regular stockbroker, calling clients and recommending and buying stocks and selling stocks. And what I found is a lot of times clients would get very excited when they had a stock that was up 25% or more, and they didn't want to sell it, even though it was overpriced. And even when the fundamentals were completely wrong, they'd fallen in love with the stock. And on the other hand, when a stock was down 25% or more, they did not want to rebuy the stock. It's just the opposite of what should be done. You want to buy low and sell high. And even if you bought low and you can buy lower, that's something that should be done. It's done for tax reasons. It's done for total portfolio performance. Okay. So that's the background going into this. One of the reasons why I manage stocks is because you can do that. That doesn't happen with mutual funds. So let's come back to rebalancing. The idea is to annually sell the funds that have risen the most and buy those that have done the worst. So there was a study that was done that showed that participants were asked to predict a coin toss. They weren't able to see whether it was heads or tails, but the person that was flipping the coin was in another room, and the participants were sitting in a room where they had a window. They could see the coin tossed. They could see it flip. They could see it come down. And the researcher would tell them if they called the coin flip correct. For the first 6 or 8 times the coin was flipped, the participant was told that it always predicted it the right way. So the participant says, I think it's going to be heads. The person flipping the coin flips it up. It comes down. And the researcher would say, oh, it's heads. Whether it was heads or tails, always told the participant it was what the participant called. And that would continue for 6 or 8 times. And then after that period of time, the researcher would tell the person who was calling the coin flip what it really was. But people who participated in the study began to believe that they could call correctly whether it was going to be heads or tails. All you had to do is set the scene for 6 or 8 flips, and they were confident that they had the ability to predict how the coin was going to come out. Sometimes they were right, sometimes they were wrong, but at the end of the game, the participants were asked about their ability to predict. and a very significant majority felt that they really had the power to predict whether the coin was going to come heads or tails. The idea of rebalancing fits in with that because generally when you're looking at a mutual fund as it's moving up, the question is not whether it's reaching a new high, it's a question of what the underlying fundamentals of the mutual fund are. R.W. Baird did a study where they found 370 mutual funds actually outperformed over a 10-year time period, an average of 1% better than the market. That was the average of 370 mutual funds. But 100% had a long period where they underperformed for at least 1 year. 85% underperformed for 3 years. 25% underperformed by 5% or more. Put yourself in the position of the financial consultant when he's sitting with you, the investor. What does he say? It's not doing so well this year, so we're going to sell this and buy something else. Or if it's way above, you're going to sell that and buy something that's underperforming. What that does is it tends to reduce everything to under average performance. Selling the test before you know, that's a difficult thing to do. We're coming to a commercial break. Don't go away. We've got a lot more to cover today. Lots to cover. Stay with me. I'll be right back after the commercial break. And you can also catch this on adamsfinancialconcepts.com.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, I've been talking about rebalancing. I want to talk about a study that was done by Samuelson and Zuckhauser at Harvard. They set up a situation for students there, management students. And they said to each of the students, you're a manager of an airline, and you have a number of airplanes. In one set of students, they said, you have a large number of aircraft, large number of airplanes. And the other had a small set of airplanes. All the planes were on lease. And they said, you have 2 years to manage. At the end of the first year, you have to decide whether you're going to add aircraft or take aircraft away. And there's no cost to either adding or subtracting aircraft. And at the end of the year, we're going to tell you what business conditions are. So they began the study, the game, whatever you want to call it. And at the end of year one, they were given the economic condition. They were told either it was good demand with fair pricing, or they were told that it was lower demand and there were price wars. And the students had to determine whether they were going to expand, contract, or stay the same. Now, there was no cost to expand. There was no cost to contract. There was no cost to stay the same. So the question was, what are you going to do because of the economic conditions? So given those conditions, the groups with the most planes were told that the economy was going to be bad, that there were going to be price wars and demand was going to be down. The group with the fewer planes were told that the economy was going to be good, that there was going to be good demand and pricing was going to be fair. So what do you do? So 50% in the group with the larger fleet of planes chose to make no changes, even though they were facing price wars and lower demand. They decided to stay with the status quo. 43% in the group with a smaller fleet of planes chose to make no changes, even though they knew that demand was going to be good and pricing was going to be fair. They chose to stay with the status quo. The correct thing in both cases was to make a change. The correct thing was to move away from the status quo. The correct thing with the students that were in the study, with the participants that were in the study with the coin flip, for them, it was to know every time that coin was flipped, it was 50% heads, 50% tails. How do you predict a coin flip? It's all this psychological buildup in your mind that you begin to see a pattern that really doesn't exist. Or in the case of the management of the planes, it's easier to stick with the status quo. And the same principle we see applies to investors in their investments. And I hope that my listeners are not the usual investors. I hope my listeners really think about what their investments are and what they're doing. Because it's easier to rationalize. It's easier to say, I like my financial advisor. It's easier to say, oh yeah, my account's not doing so well, but the market's down, or the market's flat, or the market's maybe I'm not making as much as the market, but that's okay. Most of my friends aren't either. My FA says that's good because we're taking lower risk. We're underperforming. We're taking lower risk. I always love it. I loved early when the idea of risk-adjusted rates of return came out. People began to talk about risk-adjusted rates of return. And so I did a little bit of a study with a number of people, and I said, here's a chart. Which stock would you prefer, Microsoft or Pan Am? Now, this goes back to the beginning of the 90s, or maybe the mid-90s. I said, what do you prefer? Microsoft, who had a chart where the line went up, or Pan Am, where it went down into bankruptcy? If you looked at that chart, Pan Am had a much lower risk-adjusted rate of return than did Microsoft. The question is, would you rather have Pan Am or Microsoft? That was the question that I posed way back then. Risk-adjusted rates of return seemed to me to be a mathematical excuse for getting a lower rate of return. It's an excuse for maintaining the status quo. It's really an excuse to stay doing the same thing. Delbar is a company that does studies of performance of mutual funds and mutual fund investors. Tells us that the average mutual fund investor, whether advised by a financial advisor or not, is doing worse. They've been tracking, and I've been mentioning this for a number of years, they've been tracking how mutual fund investors have been doing for the last 30 years. And what they found is that the average mutual fund investor is achieving 3.69% versus 11.11% for the Standard & Poor's. What that means in terms of dollars is the mutual fund investor being average, if they got an average return, putting $100,000 into their account 30 years, would after 30 years have $286,000. Had they just gotten market returns, it would have been $2.1 million. That's a huge difference, and that's what's happening. And yet many of the same investors will stay with the status quo. I'm not saying I'm the only person. I'm saying it's something that listeners need to think about and understand. The average investor made $285,000 or $286,000 over 30 years. Gave up $2.1 million. That's a very significant difference. That's my thought on rebalancing. You rebalance out of the good into the bad. Sometimes, infrequently, into the good and out of the bad. But usually, you're bouncing out of the good into the bad. That wraps it up. I want to introduce my guest today, who's got a lot to say about Seattle. My guest is Angela Shen of Savor Seattle. Welcome to the program, Angela.
Thanks for having me, Mike.
So let's talk about your background.
So I would be a self-described bootstrap entrepreneur. My family was in the restaurant business, my father being a chef. So my love for all things food started very, very young. I grew up in the restaurant industry, working for my family's businesses. And then as soon as I was old enough to not be cheap child labor anymore, I started working for other restaurants and getting paid minimum wage, which helped me fund my way through college. I went to the University of Pennsylvania, the Wharton Business School, and graduated, immediately started working in brand management at Quaker Oats in Chicago. And that's really how I cut my teeth in learning how to manage a big food brand, but under someone else's P&L.
Mm-hmm. And from there, from Chicago?
So then from Chicago, I moved here to Seattle, essentially sight unseen, and quit my job at Quaker Oats and decided it was time for me to finally pursue my entrepreneurial hopes and dreams. So while my mother refused to speak to me after I quit my 6-figure salaried job at the age of 25, that's when my father, who really is responsible for the entrepreneurial blood that runs through my body, stepped in and helped me as I began this path in Seattle. And I dreamed up this idea while I was living 2 blocks from Pike Place Market to start a food and wine tasting tour company here in Seattle that explored the incredible culinary scene here from the vantage point of your stomach.
Aha. So let's talk. You started a Pike Place tour.
I sure did.
So tell us about Pike Place tour. Well, first of all, the name of the company is Savor Seattle.
Yes.
Okay.
So Savor Seattle, we started 12 years ago with a tour of Pike Place Market. When I think of Pike Place, I think of it as the heart and soul of the food scene here. And there are artisans and families that have been in the market for generations. And these people very much remind me of my parents. They came from a time when making good food was enough to bring people to their businesses. And as an outsider seeing Seattle for the first time, I was really blown away in October to see such incredibly fresh produce and seafood. And I got this thought, do people who live here know how lucky they are to have this in their own backyard? So I thought, for the price of eating at one restaurant, could you instead take them to 5, 6, 7 different places, get a taste of what our city is really famous for, and learn a little something about these chefs and people who are so passionate about what they do.
So take us through a quick tour.
Okay, so it's a beautiful sunny day, cobblestones underneath your feet, and we start with warm cinnamon sugar donuts from Daily Dozen Donuts. So that's what you're starting in your belly with. And then we slowly meander to...
That sounds like a good start, by the way.
Right. And we have a rule, no leftovers ever. So you don't exactly come on a Savor Seattle food tour to not eat. That would defeat the purpose. Then across the next 2 hours, we slowly meander through Pike Place, guided by one of our expert tour guides that regale you with stories of the market while we visit quintessential artisans that are famous. So for example, Pike Place Fish, Beecher's Handmade Cheese, Proshki. Here are their incredible stories of how they got started here in Seattle. Taste what they're famous for. So iconic, best chowder you'll ever eat, coast to coast. I know that's a big statement, but I stand by that. And then finish things off with the best kind of dessert possible, crab cakes from Tom Douglas's Edda's Seafood Restaurant. So by the time you're done, you've learned a lot about Pike Place Market in 2 short hours. We've cut through all the lines. You don't have to wait at any of these places. We just arrive and food is served.
And we're going to come right back and finish the tour and hear more about other things than just Pike Place.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Angela Shen, Savor Seattle. We just started, we're almost finished with a tour of Pike Place Market, her business. Doing that tour was the beginning, but you have more that you do as well.
Right. So that was the start of Savor Seattle, were these culinary tours of Pike Place. And then each summer, as our business grew, so I started as a one-person or one-woman shop, leading tours and doing things in the office myself, answering phone calls in the car. And then now, 12 years later, we have 5 different walking food tours within Seattle, some international culinary tours to Italy, as well as 3-day, 2-night gourmet kayaking expeditions in the San Juan Islands, and very blessed to have a team of 30 employees here in our office.
So let's talk about the International Italian Tour.
So I love to travel, and I think the marriage between food and travel is synonymous. So Italy is probably one of my favorite culinary destinations, and I thought, gosh, wouldn't it be great to create an experience that takes the Savor Seattle experience, but out on the road? So all those guests over the last 12 years who have come on one of our fabulous walking tours here loved it, but they shouldn't have to come to Seattle only to replicate that appreciation for all things food. So I partnered with a great local entrepreneur. Her name's Annie Chang, who owns her own small business called The Table Less Traveled, and we curated a 9-day culinary tour to Italy, really featuring the best hits and regions of Italy if you've never been. And so everything from hands-on cooking classes to visiting, dairy farms. It's really just a great way to gain about 5 pounds in 9 days. So wine, cheese, bread, prosciutto, more. Mamma mia. So good.
And most people who go to Italy they see the cathedrals, they see the villas, they see whatever. But they're not usually there for a food tour. So take us on a little bit of the tour.
So why don't we start at the beginning? So we kick off in the Amalfi Coast. So first night is in Sorrento. Just imagine beautiful, serene blue waters. Our first meal is right on the waterfront at night. So you're sitting outside on these beautiful wooden tables, and I'm not kidding, you get a whole grilled fresh fish with some squeezed lemon juice on top, and that is how you kickstart 9 days of fresh seafood and then pasta and wine. So we go to 3 different regions of Italy in those 9 days: the Amalfi Coast, Tuscany, and then ending in my personal favorite region, Emilia-Romagna, the birthplace of so many great Italian foods. Are you familiar with that region?
Tell us about the geography of the region.
Okay.
Or tell us about the beginning and where the geography is. Give us some names of towns.
So Bologna is in Emilia-Romagna, so that is probably the most notable. So if you've seen Chef's Table on Netflix, the very first episode of Chef's Table features a chef and restaurant that's in Bologna. Now it's rated the #1 restaurant in the whole world in this teeny tiny town. So Bologna is the birthplace of bolognese, Parmesan cheese, prosciutto, balsamic vinegar, like all these great things that are so iconically Italian. And on our very last day of this culinary tour, we do all those greatest hits in one day. So you visit a Parmesan factory, a prosciutto factory, go to a balsamico house, and at like a light lunch, which is about 15 courses. And so, like I said, it's not exactly a trip you go on a diet per se, but it's a lot of fun.
So tell us about the other regions, geographic regions.
Yeah, so Tuscany, famous for wine. So we don't purport to be a wine tour company in Italy, but we certainly want to expose people to some of the geography there, as well as winemakers. And so we spend a few days in Tuscany, but also do hands-on cooking classes in the countryside. So get to make pasta by hand, pizza dough, and of course, just enjoy the beautiful countryside and learn about Italian wine.
And Tuscany has some great wines.
So, I mean, you can't go wrong,
Yeah.
right?
And great grapes.
Yeah.
Great wines.
Yeah. I take it you're a wine fan.
I am a wine fan.
What are your favorites?
Actually, more and more Washington wines,
Really?
but also the French.
French wines. I mean, Burgundy. Can't
And
complain, right?
Bordeaux, right?
And Bordeaux. I think
Yes.
that might be a preview of a future culinary tour coming soon.
So, talking about wines, talk about your wine tasting. That
Yes.
also is part of what you're doing, right?
Yeah, so I think you're referring to our newest product, which is our Seattle Wine Passport. So over the last 11 years of running Savor Seattle, we've been focused on these guided small group walks, basically, through different neighborhoods in Seattle. And really, our mission is to serve joy, and how we do that is through this language of food and connecting with the community in any way that we can. So this next leap is via technology. So with the Seattle Wine Passport, for listeners who are familiar with ClassPass, it's like the ClassPass of wine tasting at wineries. So for $59.99, you get access to 25 different Seattle wineries, and Woodinville wineries, you get to choose your 10. Show up at the winery, hit redeem in your app, and then voila, like magic, a flight of wine tastings is served. So you have a whole year to visit those 10 wineries that you chose from our curated list, no rush, and you get Lyft as your designated driver. You get $50 worth of credit that you can use over the next year. So again, you don't have to use all of that in one go either. So it's a fun way to explore the best of Washington wine at your pace and on your schedule.
So give us some idea of what wineries are there, because there are now 940 wineries in Washington.
Yeah, so we've picked, that was a hard job for R&D, right? But somebody's got to do it. We picked 25 of what we consider to be representative of the industry. So some of the big names like DeLille and Chateau Saint Michel and Janik that are in Woodinville. And then we've got some smaller ones in the Soto area. So about 2/3, I would say, are in Woodinville, and a third right here in downtown Seattle. But really showcasing the breadth and the variety of the big names, but then some of your smaller mom and pop locations as well.
You know, Wine Spectator has said that Washington has more 90 rated wines than any other region in the world now.
It's really incredible.
It is incredible.
People don't realize, I think, that Washington is the second largest winemaker in the country, following California, because we get 2 more hours of sunshine a day being so much further north. We're so lucky.
And if we have that much better rated wines than California.
Truth. We're lucky we get to enjoy that here.
There's some great California wines.
Oh, for sure. Definitely.
For sure. So, if someone wanted to do the tour in Pike Place or to do the wine tasting, how do they contact you?
Sure. Great question. So just visit our website, savorseattle.com, and you can choose from all of our tours. So our iconic Pike Place Market tours, all the way to our gourmet restaurant tours and happy hour themed ones. So there's opportunities and experiences for people with families or just looking to get out for a date night with their special someone.
It is special. You know, we do walking tours when we've been in Paris and London and other cities. We hire a guide for my wife and I, and we just go from place to place. It seems as though this is something that's beginning to evolve worldwide, is the walking tour, the 2-hour walking tour with a small group of people, but to really understand the history. And it's a really great way to see a city. And I have to admit that we've been a lot of other places doing the walking tours, but we need to really do Seattle.
Yes, it's nice to be a visitor in your own hometown.
And it's, you know, there's so much to see here. There's so much history to know. And Seattle's become a destination city. There was a time when it was just a big town, but today we're a destination city with food, with wine, with history, a lot to see and do.
Aren't we the fastest growing city in America, like 6th year running or something like that?
We are.
Yeah. Our city bird is the crane. I mean, it's insane how much growth the city is going through. But the secret's out. Seattle's a pretty cool place to be.
And a lot of things to see. And you can walk around it. And you can take the tour.
Can't promise you'll be calorie neutral at the end of our food tours. But again, I mean, at least you're walking a little bit. You're getting some exercise in there. But the idea is really to get to know the city, get a taste of this incredible place and what makes Seattle so unique in the food landscape.
Great. Thank you very much. We're going to come up to a commercial break. And when we come back, we're going to be talking about dark matter. Now, that almost seems terrible to say after talking about food and wine, to be talking about something that's dark matter and dark energy, but that's where we're going to go. Don't go away. We'll be right back after the commercial break. And if you missed any of the program, you can find it, a podcast on adamsfinancialconcepts.com. Be right back. Stay with me.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, if you grew up and attended college before 1990s or 2000s, you probably never heard about dark matter. Maybe now you've heard about it. Maybe now you haven't heard about it. It's been something that has been relatively recent. And yet, dark matter, they consider that it makes up 85% of all matter. The radio you're listening to, the chair you're sitting in, the food you eat, the things you buy, all those things are made up of atoms, and that's 75% of ordinary matter. You know, if you look at our bodies, we contain 10 times the number of bacteria cells as we do of human cells. And we're not even aware of the bacteria until we get sick. The same is true. Like bacteria, we don't notice billions of dark matter particles which are passing through our bodies every second. All that according to Lisa Randall, who wrote a book called Dark Matter and Dinosaurs. She's a physicist who proposed that the role of dark matter in the extinction of the dinosaurs and millions of other species. It was dark matter that caused the extinction. And there's a lot to the theory, and I'm not going to go into the theory, but I want to talk about dark matter because Frank Zwicky in 1933 first observed dark matter, but he didn't really understand what it was. He didn't name it. It was something curious that was happening in galaxies that was observed. Didn't have the equipment to really detect it. Wasn't until the 90s and 2000s that we really had the equipment and sophistication to really look at it. They noticed that something was bending light. To give you an analogy, we have a high-rise building. Suppose you're standing in front of Columbia Tower building, that 75-story building. You're standing right in front of it, and on the opposite side, there's a high-rise building. But to the naked eye, as you stand there and look, Columbia Tower building obscures what's behind it. You can't see that building behind it. But if you take a picture, that picture in the analogy, not in reality, but in analogy of what's happening, you see the building behind it on the right side and the left side. You see it on both sides. Because what's happened is for a galaxy, as we look into the galaxy, into the universe, the galaxy, as you look toward one star system, there's another star system behind it. that shouldn't be visible because there's something blocking the view. But what's happened is something has taken the light from the hidden star system, and you see it on both the right side and the left side because something is bending the light. And what's bending the light is dark matter. You can think of it like a rock in a river. You have the river flowing down, and you have a rock in the middle, and the water flows out around the side of it. That's what's happening with light. Something's causing that light to go around. So that dark matter has a gravitational pull on light particles. Now, we've grown up, and we've known for a long time there's no ordinary matter in space. Space is a void. Or at least we used to think space was a void. Today, we know that space isn't a void. Space has no ordinary matter, but it has dark matter. And the gravitational impact? There is a gravitational impact, but if you think of it, those galaxies are many, many light years away. Bending that light is a significant factor. It's not like the description I described at the beginning where you're standing in front of the Columbia Tower and can see the building behind it on either side. That's an analogy, but it's only a partial analogy. It's a small gravitational pull, but it really exists. And that's only part of the description of what dark matter is. The lesson of physics, as Lisa Randall says, is how much is really hidden from our view. Philip Hope Higgs in 1964 theorized there was the so-called God particle, what's called the God particle, the Higgs boson particle. Standard physics built a whole theory around that particle, having never seen that particle, having never understood that particle. But unless that particle exists, all standard physics goes down the drain. All the theories about physics go down the drain. It wasn't until July 4th, 2012, in the CERN collider that they identified and found the Higgs boson particle. Science has a characteristic that can be proven false if everything doesn't align. If there was no Higgs boson particle, all those theories that have been built up about physics could be proven absolutely false. If we don't have dark matter, all those theories that are now generated about the origin of the universe, about the expansion of the universe, about how things are moving, star systems and galaxies are moving, and how they condense into a white dwarf and all the things that happen. If dark matter doesn't exist, all those theories go away. The big lesson of physics over the century is it's hidden from view, but it exists, it's theorized, and it's found. Now, that's real science. There's a pseudoscience where you cannot prove things that are false. Economists would have you believe that we have a market and an economy which obeys economic laws. Modern portfolio theory was built up about that. Harry Markowitz in the 1960s, building on a work of Irving Fisher and others from the 1920s, founded this idea that stock price movements are based on the market movements and individual company movements. Mogliani and Miller from now Chicago, they were at Carnegie Mellon University where I got my MBA. They're now at the University of Chicago. They come up with this idea of the capital asset pricing model. Fama came up with this idea. Eugene Fama, who shared the Nobel Prize in 2013, came up with the idea of quantity and beta and alpha, and an efficient market that was completely rational. And while it sounds so wonderful that we have this rational market, the fact is it hasn't proven true. The idea of a modern portfolio theory sounds so wonderful, logical, and reasonable. And so much work has been done on it. That is the whole idea of modern portfolio theory. The idea of asset allocation, that you can have different asset classes that are uncorrelated so that when one goes down, the others go up. It's like the teeter-totter. We proved in the Great Recession that it didn't work. Listen to some of my early newsletters back in the 90s. I said that it didn't work, and it didn't work. It's not like dark matter or Higgs boson or chemistry or biology. We live in a dynamic market which is constantly changing, and if you're an investor, you need to be constantly changing your focus, your investments, not on a daily basis or a weekly or a monthly basis, but on a constant, regular review time. That wraps up today. If you have missed any of this, you can find a podcast on our website. You can find it on YouTube. And until next week, have a very good week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.